relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. On Money Friday, this is Your Money, Your Call.
Welcome to Your Money, Your Call Friday edition. It's the, let's say it's the final edition until I go on 2 weeks holiday. Richly deserved, I advise myself. I'm Mark Todd from the NAB. I'm joined by Dan Miles from Innova Asset Management, and I have Richard Murphy from XTV. They are here to answer any of your questions. Feel free to call us. It's 1300 30 34 35. The email is yourmoney@skynews.com.au. We have got a lot of followers on the podcast. We have a lot of charts to go through today. So over the weekend, I'll put it on some sort of platform, LinkedIn. I'll put it on LinkedIn so you'll be able to find the charts there, and we'll send something out on the tweet. It's Mark Todd 8 on tweet, so we can send you all the links and that sort of stuff. Welcome. How are you guys?
Well, thank you, Mark.
Good, thank you.
How's XTB? It's been a couple of weeks, maybe 2 months. How long has it been?
Well, I haven't seen the new set, so since before the new set. So
yeah, it's pretty.
Looks very pretty, yeah. Awesome.
How things on XTB? So for the people that are just newly watching or hard of remembering, walk us through XTB.
Yeah,
XTBs. What do you do?
XTBs are exchange-traded bond units. What the business is all about is giving you access on the ASX to individual bonds from the companies you know on the ASX, so the top 50, top 100 companies. And so you can buy a BHP bond or a Woolworths bond or a Telstra bond in this XTB format.
Yep.
Previously, you could only get that off the exchange in much larger lots, so they trade in $100 lots, and it makes it more accessible to individual investors.
And open to retail?
Open to retail, yep, absolutely. Most of our clients would be retail.
The platform distribution is through, like if somebody wants to find you, what's the means? You know, it's early in the show, folks, so you might not want to find him at the end of it. We'll just work this out, okay? We'll just start first where you can find Richard. Right. ASX listed, so where do we go? Through your broker, through your advisor?
Yep.
Advisor helping you work out which ones to buy?
Whichever way you access BHP shares or ETFs or REITs, you go through an online broker like NAB Trade, you go through a full-service broker like Ords, etc.
Yep.
You go through your financial planner, whatever mechanism you get that gives you advice on whether to buy these shares or those shares or this ETF or this REIT.
Yep.
It's the same with XTBs. So because they're on the ASX, it's the same way too.
We'll talk a little bit later about the types of securities that are on so that we can just extend it out, the excitement, so people will Dan, how are things?
Good, things are good.
Innova, let's walk us through. Give us the 30,000-foot view of Innova. What do you do and how do you get out to the client set?
A simple way to describe it is goals-based global asset allocation portfolios. We have a particular focus on risk because we think if you're going to be managing a portfolio for a client to achieve their goals, behaviour matters a lot more than returns. Returns matter, but behaviours matter more. So we spend most of our time trying to concentrate on maximising return, but with very strict risk parameters. And we use asset allocation to control for that risk. So we can invest in just about anything, anywhere around the world to try and maximise that return. But as I said, with very strict risk parameters.
We'll talk about risk in a second, but we have our first caller for the night. And I'm not sure who it is because no one's told me, but I'm sure there'll be... Hello, John. How can we help you?
Yes, good evening, Mark, and thanks for taking my call.
No problem.
I have a self-managed super fund with about 540k in it, so leaving that aside, my question is, I have 1,000 Bank of America, which current price is about $23, equivalent to 30k Australian. I'm looking at purchasing 1,000 NAB and then availing myself of the margin trading loan.
Yep.
So I'm backing NAB over Bank of America. I'm overweight Bank of America.
Yep.
In my own name. I have 31,000.
Yep.
I'd like to balance that against NAB, plus avail myself of the 1-to-4 ratio. Do you think NAB's a good bet?
Right, okay.
Thank you very much.
Pleasure. So, setting aside the natural conflict that I would have here, to some extent, and trying to... So, John, I will endeavour to answer the question, but have a job when I come back from holidays. So let me think that through in respect of, I'm unsure. So the reason for the sell-off in the banking sector, can you both tell me why the banking sector has been sold off? So I'll start with you, Dan.
Banking sector in the US has sold off because people have got questions around the Trump reflation trade.
Yep.
If you think about how banks predominantly make money, they borrow short and they lend long, right?
Yep.
So the long end of the yield curve, there was an assumption that Trump's policies would lead to inflation, given that the US economy was trundling ahead and was at full employment.
Yep.
And so the long end of the curve would expand out, and that would be very positive for the banks, plus that the pendulum had swung to the other side as far as regulation had gone. There would be deregulation on the banks.
Dodd-Franks.
Yeah,
bring it back.
Exactly. So now there's question marks over whether he'd be able to get any of that through, and so the financials have sold off. Domestically, similar sort of trickle-down effect, plus we've had the budget come out and people slamming the banks, and there's question marks over the sustainability of the Eastern Seaboard property, housing prices, and so combine that together and we get a sell-off in financials domestically as well.
Same sort of thing?
Ditto, same thing. No,
right.
Agree entirely. Yeah.
Okay, so John, here we go. We're going to have a crack at it. I don't know anything about your financial circumstances, so take that with a grain of salt and go and get the advice if you need to get the advice. There is a dividend yield of about 9.65 on the NAB at $29.31. You've just said you'll get some leverage at whatever that's going to be, 5%, whatever that leverage is. So you're probably your outcomes will be something closer to, let's say, about 15% on the basis that NAB can pay that dividend and the capital price doesn't move around too much. So my question to you is, can you absorb the volatility and can you back the NAB management to deal with what Dan has just described? So can the NAB management manage the Eastern Seaboard repricing of property? You know, are they aware of it? That's the first thing you want to know about. I guess they are. They're the ones that have stimulated it because they've said we're changing the way we price interest-only loans. So there seems to be a management engagement. Regulatory risk. So if state governments offer, you know, the joy of a new tax hike, there is some risks around how that gets played out. Again, do you back the management to try and work out, do they take it out of my pay, your loan? So this literally comes down to the idea of, can you back the management of the bank to be aware of the problems that Dan's described and there's no black swans, and are you being compensated for the risk at whatever 9.5% plus the loan would be? You know, on balance, if you said to me, I'm making that case, I wouldn't necessarily say I can see an obvious hole. Is that a reasonable response?
That is a reasonable response, and to be honest with you, look, I can only talk in generals. I'm not a stock analyst, but I think the odds are the long end of the yield curve to the upside. I think this peeling back of the reflationary trade and the Trump trade, you know, there's a very good chance that that's a short-term thing. So, you know, does that mean financials will do well from here? Well, they're kind of a call option on higher inflationary expectations in the future. So just financials in general, you know, but I'm not a stock analyst. So.
No, I'm not. Again, we're not trying to offer stock analytics. What we're saying is, if you look at the macro themes, so when we have John Pearson from Uni Super, he says, look at the macro themes. What are the people think the problems are with the sector? Can they be addressed? You know, basically you're trying to say, does the Australian economy continue to grow at 2 or 3%? And if so, then the banks will be somewhere thereabouts. And so that seems to make some sense, and you just want to work out if they're, you know, well managed. If I think of the ANZ, they're trying to change a whole part of their business. There should be, in theory, more volatility around that idea that you are recalibrating the big ship ANZ. You know, CBA is prosecuting the business it's got. Westpac, to an extent, is still doing the same thing, and NAB has executed. Now it's about trying to prosecute its business. It's sold Clydesdale. It goes, I guess, in order of what you'd be worried about. It'd be ANZ, it'd be NAB, it'd be then Westpac and then CBA. NAB's the one that's everyone's seen as the resurgent because it's executed. That seems to be the way people are talking about markets.
Of course, the other thing we'd all probably agree on to say to John is, John, we hope in that 560,000 in your super that it's not all sitting in just in equities, that you have other asset class diversification in there as well.
Yeah, and again, it comes down to the question, John, whether you can absorb volatility. You know, if you get it wrong, your risk is that you're levered against it. You could get it wrong and then a margin call. So you've just got to work out, you know, do you use equity options?
I can't use equity options in our client portfolios because of the way we execute, but we do use managers that utilise equity options. And at the moment, I mean, I've got 174 indicators or something here. There's almost nothing is green because there's not a lot around the world that's particularly cheap. But the VIX, if people don't know what the VIX is, it's a measure of implied volatility. Implied volatility is one of the components of option pricing. Don't just go out and buy options blindly all the time, because buying options will mean it'll eat away your return over time. But at the moment, options and option protection is one of those things that's actually relatively cheap at the moment. The AVIX in Australia, so some people have heard of the VIX, that's in the US. The AVIX in Australia has been around for a while. It's down at 12.5. So we use managers that have protection strategies in place. And we think it's prudent to do that when things are on the higher side of price and the cost of insurance is at the lower end. It doesn't mean that you're predicting there's going to be a crash, but if it's relatively cheap to take out insurance against a relatively expensive asset, you know, that sounds like a relatively common sense idea.
So John could do a situation where he buys NAB, he gets some leverage against it, he then uses the money that he didn't spend on buying NAB because he's borrowed to buy an option. You buy a put, so if NAB gets sold off, you can execute on your put, you've got some protection. It will mitigate some of your returns because you spent some money on buying protection, but John, that means you sleep safer. You know, if you aren't able to absorb vol, that is an option to take. That sort of seems to make some sense.
Yeah, exactly. Look, and it depends on the circumstances. That's why they give you a call and have a chat to Mark and ask for their particular circumstances. But I think at certain times it makes sense when insurance is being offered at a relatively low price. That's when it might make some sense to consider it, which is why we use strategies that are taking out insurance at the moment.
And the other thing, Richard, is that you can then say, look, if I look at a balanced portfolio, I might then say I'll buy some stabilisers in my portfolio, might be some of the product that you're doing.
Some fixed income, yeah, some bonds, etc. Yeah, and I would just say to John on options, just be really very, very careful. I mean, I ran the options market at ASX. It can be illiquid. You need to know what you're doing. If you don't know what you're doing, just don't rush in and start buying equity options.
Don't do it yourself. Go and talk to a professional.
Yeah, and that's the same with all the commentary we're saying. If you're unsure, feel free to go and get advice, because there's lots of advice out there. We will take our first break for the night, and we'll come back and we'll talk about some emails from Barry. Talk to you soon.
What did he say? He says you can see quite well.
Donate to the Fred Hollows Foundation today and help restore sight.
Fully wedded wife. I should have gone to Specsavers.
Hurry into Specsavers for a huge 50% off a range of selected styles, complete with standard single vision lenses. Sale ends July 1. Should have gone to Specsavers.
The world is full of hidden treasure, just waiting to be discovered. So look a little closer and see what others don't. Join Expedia Plus Rewards today and discover member pricing and more.
Nobody can tell you there's only one song worth singing. They may try and sell you, 'cause it hangs them up to see someone like you. But you gotta make your own kind of music, sing your own special song.
Get that tax-deductible feeling right now at Officeworks, where everything could be tax-deductible, like this versatile Lenovo IdeaPad laptop, just $329. Or this Samsung Galaxy S8 with stunning infinity display, only $1,197. And back up with this 1TB WD Elements USB 3 portable hard drive, just $68. With thousands of potential deductions in-store and online, Officeworks is your happy tax place. If you've got the big ideas, Officeworks has the lowest prices.
Fame's fickle. While some are celebrated, others go unrecognised. Take the traffic light, saved so many lives. But whose brainchild was it? Yeah, whoever thought of roasting coffee beans? The mobile phone, who was the inventor? What about Wi-Fi? Any ideas?
You don't have to be famous to be brilliant. Skoda. Simply clever.
A rental property can be a rewarding investment, but even with great tenants, There'll always be life's unavoidable accidents and uncertainties. Standard building insurance may not cover damage caused by tenants or loss of rent, leaving you out of pocket. Terry Shear is Australia's leading landlord insurance specialist, with award-winning landlord insurance from $1 a day to protect your property and rental income. Call Terry Shear today or go online.
Time is running out to get your exclusive Meerkat toys. Sorry. To get yours, buy health insurance before June 30. Call 13 32 32 or visit comparethemarket.com.au. Simples.
Welcome back to Your Money, Your Call. I've got Dan Miles from Innova Innova Asset Management and Richard Murphy from XTB. I'm Mark Todd from the NAB. We are here to answer any of your questions. We got to question 2 and then we had a segue. But if you want to email us, it's yourmoney@skynews.com.au. The phone number is 1300 30 34 35. We're open to anything. Feel free to call. We have an email, and we have an email from Barry, and Barry asks, and Barry writes some crackers. While the Fed is raising interest rates, they are reducing the present value of their huge bond pile. So I'll take it in part. So what he's saying is if you hold assets like the Fed does, as you lift rates because they are fixed rate bonds, the value of those bonds are reduced. I bought something at 1%, cash rates go to 2%, that 1% is now not as valuable. I understand that they will hold to maturities, there is no capital loss. Does that change in present value? Does that change in present value impact the market in any way? Does it affect the way they manipulate bonds in their QE pile? Do you want to have a crack at that?
Short answer is, actually, you're the bond guy. Do you want to?
Yep. Do you want to have a short answer? We were discussing it over the break. The short answer is no, because they're not actually going to sell any of the bonds. If they turn around and start selling bonds, then A, they'd be impacting the market anyway because they've got a truckload of them, and B, they'd be selling those bonds obviously at a reduced value, so it would affect the market. But they're not. They're holding to maturity. So you're absolutely. The answer is implied, Barry, in your question. And the fact they're holding to maturity does not affect the market in any way.
So it's a balance sheet story where they have assets that lose in value, but these guys in central banks are probably the worst traders in the world because that's not their intent. Their intent is to either flood the market with liquidity or take liquidity out. And so what they've done is the flooding. And the idea is they'll change at about $6 billion a month. So they say as the bonds mature, Barry, they just hand the money back to the government. The printing press stops, and what they're trying to do is look around for those who might want to buy the securities as they get reissued. So the key to all of this is that the borrowers want to borrow again. And so if, as Dan said, Mr. Trump comes out and says, I need a lot of money, I've cut a lot of tax, I need a lot of money, he'll issue more bonds. And so that's the key to all of this, because at what price do the bonds get reissued? So let's say the 5-year bond is now at 5%. All the assets you own are now not worth an awful lot. And it's a question of how you respond. The central banks will not move. They will not prioritise the ones that they like in value. They literally just let them roll off, and that's all they'll be doing.
The net present value of the bond portfolio in which they hold is not particularly important to them. The liquidity of the overall system and how they can manipulate the long end of the curve is what their goal is, right? It's not actually maximising the value of the overall pot.
Absolutely. So tell me what trends you're seeing in your business. What has XTB seen as a trend, like, in terms of new issues? Give us some colour around who you're seeing come on and how many issues do you have and what sort of fun, like all that sort of stuff.
Yeah, look, we've been growing. On Tuesday we get to 50 XCBs. Another 3 start on a Tuesday morning.
Who are the 3?
Telstra, Dexus, I think, is one, and then there's Transurban in Queensland, or down in Melbourne. And then we're bringing on an awful lot more IFAs all around the country. So as the message gets out there about fixed income is good, we need more bonds in our portfolio. We need to be not so dominated by equities on one side and cash on the other. As that message grows and grows, we find our sales are going up and growing. So we got to 100 million after a year and a half, and it only took us 6 months to get to 200 million. So
is that where you now are? You're 200?
Yeah, we're 210 now or something like that. So, and that keeps on growing as more and more clients come on.
How often do they turn over? People mainly buy and hold.
They are buy and hold. No, we have only bought back less than 5% of everything we've sold.
Yeah, right.
And you know that some of that has been big blocks we knew were going to come back. Because somebody said I'm only in for a year, but really it's buy and hold. So even when Qantas bonds shot up, you know, when they got upgraded, the people who'd bought them didn't sell them taking a capital return. They liked the fact that it was a 3.5 or 4% yield at the time when they bought it, and they're holding that through to maturity.
So what sort of yields are we getting for the new three that come on? Telstra, what are they? Telstra, which ones?
So the Telstra is a Telstra 23 or something like. I don't know the exact date. Yields are obviously at the moment lower than they were in January, February. So they're in the sort of high 2s, low 3s,
right,
at the moment. So. But that's people are still comparing them back to what am I getting out of a term deposit. It doesn't matter that some non-investment grade bank is paying 2.8%. Most people are in NAB and Commonwealth Bank, etc., etc. So they're looking at their TD rate.
That dig he gave to that poor little bank that was re-rated by that ratings agency that poor little bank doesn't like anymore. Did you see how he did?
Well, most of the money is in the four majors, and you know the other say 4 or 5 top 10 banks. You know, that's where most of the money is. So it's the rates that they're comparing. Most of the people that invest in XTBs are saying that's what I'm getting in a TD, and I want something a bit more than that. I don't want the. And I have got equities and I have got hybrids, but I know that's a lot more volatile. I want something that's not as volatile.
Yeah.
That gives me a bit more yield for a bit more risk. I know there's more risk, and therefore that's where senior bonds fit in.
Yeah, I have no problem with XTB. You know, it's a retail option. We have a lot of people who. Pete would email me on a regular basis, so you're not telling enough people about where, as a retail investor, you can get access. So I'm not saying that they're good, I'm not saying they're bad, but they are a retail opportunity. If you're a retail investor, you know, this is something you can do. You can buy them for $1,000 or $100. In when you talk about risk, how does that sound to you in terms of the paradigm? And don't get me wrong, it's not a gotcha moment. I'm just trying to understand how you're thinking about portfolios, and you talk about that risk-adjusted returns and the likes. How is senior bonds right now at those sort of spreads? How do they look to you at the moment?
We break them down into the factors themselves. We've liked investment-grade corporate credit domestically in Australia for quite a while, and in fact it's rallied quite heavily in the last 12 months in the space that we've invested in. We haven't liked just pure duration. We haven't liked sovereign bonds paying yields of 2.2. So how do we think about that? We think about whether we're getting a sufficient credit premium and whether we're getting a sufficient duration premium. We continue to think that investment-grade corporate credit in the fixed income spectrum is one of the only places that you're actually getting a reasonable return for the risk you're taking. In the high-yield space, we think that the option-adjusted spread at about 400 over is nowhere near enough. We think, you know, the majority of corporate loans look pretty attractive in Australia as well, but we've liked credit for a while. What we don't like is the majority of the sovereign assets that have been issued, because there's just not enough there. So, you know, we for a number of years we looked silly because everybody was piling into sovereign bonds, getting fantastic returns, and we were in corporate credit.
Yep.
That's reversed in the last 18 months. All of a sudden, we look a lot smarter than they do, and just. Quickly, I mean, if people look at the corporate bond index, just the just the Bloomberg Osborne corporate bond index. I think there's only been one default ever in the entire index's history. So, the credit premium that you get for taking on that risk is, you know, it's a great premium.
Yeah, but you know, let's be honest. When something's in that corporate bond index, it's investment grade, and when they default, they're not. So there'll be a transmission around when you know the ratings agencies will step in and make them non-investment grade. So then they get blown up.
Yeah, but there's only been two that have been taken out.
Done that though.
Yeah. But everyone, I was just about to say, I'm the bond guy, right? So everyone be calm. We want a balanced approach here, but bonds don't really go under. There's not that many. You'd be very hard to find them. You'd be really struggling to find them in your portfolio. So. Most people bought those with the people that actually owned the company. The Fed lifted rates. Maybe they'll lift rates again this year. What did it do to the customer's attitude towards... I understand that you're growing, don't get me wrong, but it's this idea that Fed lifts rates and everyone goes, oh my gosh, don't buy bonds. So what happened when Fed, people got a better return?
We've kind of noticed over the last 2 years that, first of all, in Australia there was, a couple of rate cuts, and then in the US, a couple of rate rises. And after these events, there's just a pause. People kind of pull back, and advisors pull back and say, look, I'm going to think about this for a little while. I don't need to rush into this. It's not like I'm going to miss the IPO date or anything like that. And so we get a bit of a lull in activity, and then it kind of comes back more in a bit of a rush as they've decided, right, now I've now got my head around what that means for the market as a whole. You know, the Fed rate was priced in, nothing's really moved that much, and so we just notice, I don't know if it's 10 days or 2 weeks, whatever it is, of as soon as there's a decision like that, there's a bit of pause, a bit of contemplation of what it actually means, whether up or down, and then they kind of come back and we start the usual pattern again.
When you talked at the start of the show about how many metrics did you say that you follow?
Oh, the valuation measures, 170-something each week, but there's a lot more that goes into it than that.
And so if there's 170, so you're give me an example of what might go into it without going, giving up your IP. Are you saying that the filter gives you one outcome, so you might look at high yield credit, of which there's so many high yield credits, and it'll give you an outcome. Is that what you mean?
Yep. So we'll try to understand the economic footprint of a particular market, and then price compared to that economic footprint, and how it looks compared to history, and how it looks compared to other markets.
So we've got 1 minute before we go to an ad break. How long of that 174 you're saying there's no green?
Oh, there's a little bit of green, but there's not a whole lot.
So how long has it been of that standard? So in other words, has it been like that for 3 months, or is it only... So I'm trying to have a sense of what's happening in that trend.
Yeah, it hasn't really been glaringly green since about late 2011, early 2012.
We'll go to our second ad break, and we'll come back and we'll talk about what markets are doing globally, so you'll get a sense of where there might be some value, there might be a little bit of green shoots somewhere. We'll try and find green shoots. We'll talk to you soon.
We know you've always worked hard for your money. Isn't it time your money worked hard for you? Invest with Latrobe Financial, trusted by Australians for more than 60 years and judged Money Magazine's best mortgage fund 8 years in a row.
Things are done differently around here. Abbott's Village Bakery loaves are free to enjoy all of this. We only ever feed them the good stuff, just grain-fed. We just let nature do its work. Oh, but Frank's pretty handy to have around too. We roast them free range, so you can taste the difference. Introducing Abbott's Village Bakery Harvest Pumpkin and Sunflower Seeds.
The world is full of hidden treasure, just waiting to be discovered. So look a little closer and see what others don't. Join Expedia Plus Rewards today and discover member pricing and more.
There's now a better way to protect yourself from frequent heartburn. Nexium 24-Hour. For 24-hour protection to control frequent heartburn. Just one tablet a day, 24-hour protection for frequent heartburn relief.
Clark Rubber's 30% off store-wide sale is on now. Get 30% off the recommended retail price on everything pools, everything foam, and everything rubber. Hurry into your nearest store or online. Sale ends Monday. Clark Rubber. Everything pools, foam and rubber.
Get that tax-deductible feeling right now at Officeworks, where everything could be tax-deductible. Like this versatile Lenovo IdeaPad laptop, just $329. Or this Samsung Galaxy S8 with stunning infinity display, only $1,197. And back up with this 1TB WD Elements USB 3 portable hard drive, just $68. With thousands of potential deductions in-store and online, Officeworks is your happy tax place. If you've got the big ideas, Officeworks has the lowest prices.
Fame's fickle. While some are celebrated, others go unrecognised. Take the traffic light, saved so many lives. But whose brainchild was it? Yeah, whoever thought of roasting coffee beans? The mobile phone, who was the inventor? What about Wi-Fi? Any ideas?
You don't have to be famous to be brilliant.
Skoda. Simply clever.
Look close. Werther's is making no sugar added caramels that are so smooth, rich and creamy. You won't believe they're no sugar added. Discover them in delicious caramel flavours you'll love. Werther's Original No Sugar Added.
Welcome back to Your Money, Your Call, the Friday edition. It's the Bonds edition. I'm Mark Todd from the NAB. Now, if you need to email me directly, it's mark.todd@nab.com.au. I will be on 2 weeks' holiday as of Sunday, so it might take me a while to come back. And if it is an abusive email, it might take me even longer. I'm joined by Dan Miles from Innova Asset Management and Richard Murphy from XTB. They're here to answer any questions, and we'd love it if you call us. Call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. We have a few emails to get through. We have an email from Ray. And Ray writes, can you please explain the difference between running yield and yield to maturity and yield at issue? Right. Who wants to do that one?
I'll explain running yield and yield to maturity. Who was it? Ray. Running yield is very, very similar. Most people know about shares more than they do about bonds. So if you own shares, you understand the concept of dividend yield, where you get a dividend, you can divide it by a share price, and that gives you, well, what's the return I'm getting on that dividend, and that's a dividend yield. Running yield works the same way, where you're getting a coupon, and you can divide that coupon by the current price of the bond, and that will give you a running yield, which is kind of the yield at that point in time.
So if we gave you a practical example, if somebody was to issue a bond and you bought it for $100 when it issued and it had a 7% fixed rate, you would get 7%. That's your running yield. You'll get it every 6 months, normally because they're fixed go every 6 months, and you'll get 7% on your money. So that will be the running yield, the cash that you're going to get.
Yep.
If it was a floater like a hybrid, the running yield is a little bit more of a guesstimate. So think of CBA Pearls 9, issued at 5.2% over the cash rate or over BBSW. So you got 5.2% plus BBSW. That was your running yield. There's some nuances around that, around franking and the like, but it's actually, think of it as the cash you're getting as a yield. I'm getting $100. I invested $1 million. It's that running yield, that return you're getting.
But I had a big but there, which is, do not look at that number and think, oh, look, there's my return. That's what I'm going to get. Because let's go back to that fixed rate bond example, where let's say you're getting 5% in the bond price. It was $100. You think, oh, my yield to maturity is 5%. No, it's not. Your running yield at that point in time is 5%. Your yield to maturity will be an entirely different number, and you'll notice it's probably a lower number.
Let's deal with that. So the yield to maturity, Richard's saying he's right. If you buy something at $100 and 7%, the running yield and the yield to maturity will be the same. If you hold the maturity, you'll get the same. You get your $100 back. What if you paid $110? Well, at maturity, you will lose that $10 investment. The borrower will only ever give you $100. So now I get a 7% yield for the life of the bond, and then I lose $10 at the end. So it's 7% less the value of that $10 to get my yield to maturity. So it might be 5% yield to maturity. Losing that capital, it impacts your total yield. And yield at issue, that's what we've been talking about. Bond was issued at 7%. That's the yield at issue. If you hold it and you pay $100, that's the outcome you'll get. $100 yield, running yield, and yield to maturity.
Fantastic education source for this stuff is Investopedia. They have a really good description.
Investopedia is fantastic. You could sign up for Bond Advisor. You could find that. You could go onto the ASX. Will probably give you something along those lines. Bond Advisor is probably the one that I know the best. Investopedia is definitely great, and Bond Advisor will do some. They've got a library of educational pieces where you can sign on. They'll give you a newsletter, so you can try and do that. That's free as well.
Yeah, and we've got that on our website as well. If you want onto XCB website, you'd find what is running yield, what is yield to maturity, and a kind of good explanation of what it all means.
Hopefully we've answered that one. Now we have another one from Andrew, and Andrew writes, if Argentina can produce a 100-year bond, should we start looking at a 50-year? What do you think?
I wrote an article in June last year saying that we should be issuing as much to the government, we should be issuing as much long-dated debt as we possibly can. We have...
so a 49-year.
We looked at debt in Australia and yields in Australia back to 1857, and this is as low as they've ever been. I actually think we should absolutely be issuing bonds at 50 and 100 years. Now, I wouldn't be a buyer of those bonds, but I think the government should. I think it's a great idea to fund infrastructure projects for productive assets. Pardon me?
It's good debt.
It's good debt, yeah. That's what's now termed good debt as opposed to bad debt. And it wasn't just Argentina. Ireland did the same thing. There's a few places that have issued these sorts of bonds. I think it's a great idea.
Walt Disney issued a 100-year bond.
Oh, did they?
Yeah.
Okay, there you go. And, yeah, I think it's a fantastic idea.
Austria, I think it was, issued... I mean, sometimes people worry about the price, at 20 basis points or 1% or 2%. People worry about that, but I get all that. But, yes, your thoughts?
I mean, I agree as well. And the Australian government should be doing it for infrastructure and remove the politics from it. Of course, that's impossible, so that's not even realistic. But this is the time to be issuing if you can get away 30, 50, 100-year borrowing and then go and spend it over the next 5, 10 years building infrastructure that's productive for the country. That's a great idea. I also agree I would not be buying that either because that's got 100 years to maturity. It might as well be equity. It's perpetual. Effectively, from my perspective, I'm not going to be around in 100 years. So it's that I wouldn't consider that even fixed income in the way I would think about it from my personal investing point of view.
So Andrew, we've all got 3 out of 3 that say you should do that because everyone thinks that we should have an infrastructure. I think of it slightly differently. I think it takes some of the politics out of the noise. Your borrowing is so long dated. Once you've borrowed enough money, you're not really worried about the rating agencies as much because you're not borrowing as much short-dated. You just whatever. Your ratings agencies can do whatever they like. You're trying to invest for the longer term because I do like that good debt, bad debt story. The other thing to think about, Andrew, is where does BHP borrow? BHP goes to the US, it goes to different places and borrows really long-dated. Now, what will happen is if you have a 50-year curve, if I want to lend to BHP, I could think about it relative to that 50-year curve. So let's say Australian 50-year curve is 5%. I might want to charge BHP another 1% above that, so I can lend BHP money for 6%. Now people might start saying, well, BHP rather than the equity, I'll lend to the debt. And I'll say, I'll get 6% out of BHP because I think BHP will be around for a long time. That's when people start to get really excited about a longer dated curve because what we can do is get really long dated borrowings for corporates who could then invest in their business. That's the way to start thinking about what a long-dated curve actually does. Takes the heat out of the government, improves infrastructure, but it also brings the corporates in, and that's a really big deal. Right, now we have some... hopefully we've got some charts. So have we got a phone call from Clive? Oh, good Lord. Okay, we're busy. Clive, how can we help you? Brisbane. Oh, no.
G'day, Mark. How you going?
Oh, no. Don't talk about it. That 2 minutes ago, I haven't actually reconciled that yet. The state of origin. Clive, you want to talk to us?
G'day, Mark. How you going?
Good.
I'm a Blue supporter, by the way.
Oh, thank God. Okay, great.
Hello,
day. Clive. How you been? So walk me through bonds versus equities, mate. What's your question?
Yeah, well, I mean, look, I understand asset prices are expensive both in equities and bonds. It's easier as a retail investor to understand the downside to equities. We've seen the US markets, rally 300% in the last, 6 or 7 years.
Yeah.
What's the downside for bonds in the event of a sell-off? If I'm looking for a 4% return in a corporate bond fund of some kind, what is the worst possible scenario in that instance?
Sure. I'll
go take it?
One at a time. It's easy. What do you think? What's the worst? So, Clive, what we're going to talk about is effectively the binary impact of bonds. You either get your money back or you don't. So that's the worst case. You don't get paid off. But let's talk through how that plays out.
There's a couple of things. It depends on which bonds you hold. So you could hold a series of floating rate and where increase in the interest rates aren't going to have that big an effect. And so what could cause a loss is a credit default, right? So that's where the loss is going to come from. But what I think Clive is more talking about is in your typical bond, like the index in Australia is the Oz Bond Composite. That has about 5 years worth of duration in the portfolio. If we had a 1994 scenario where yields went from 6% out to 10%, if we had yields go from 2.5 to 6.5, so increased by 4, that could be a mark-to-market loss of roughly 20-odd%. that's a pretty hairy scenario if that's the type of bond fund you own. But if you are holding corporate bonds that are all relatively floating rate and we don't see any credit event, we don't see any default on the credit side, and everything you own is largely investment grade and fairly senior, it's extremely unlikely that you're going to see any kind of credit event or downside. So it depends on the bond fund itself.
And I think another good point is there's a very big difference between holding bonds individually, say you're holding 10 bonds individually, and then holding those 10 bonds in an ETF or a managed fund where the event does happen. Let's say there are 10 3-year bonds and they've all fallen in value. You don't need to sell them, you can hold them to maturity, and you kind of get out of jail free for that particular event. Whereas if you're in a perpetual vehicle like an ETF or managed fund, that's it. It has actually happened. Your unit price will fall, and so there's a very, very different experience and a very different outcome of holding bonds individually because they mature versus holding them in any managed fund or any ETF, because those vehicles are perpetual, and you lose one of the most fundamental features of why you invested in fixed income in the first place is they mature, and that gives me all that predictability I wanted. So that terrible event that Dan's talking about happens, and then let's say it corrects itself, and you're holding, you can afford to hold these bonds. When it comes to the end, they all mature, and you got the yield to maturity you bargained for on day one. In the mid-time, Dan's terrible event happened, but you still got your 4% if that was the average of those bonds because you just held to maturity. Whereas over here in the ETF, you're stuck.
So Clive, if I can preface what Richard's saying, this is the difference between direct investing versus fund managers. So in the direct investing story, the worst case scenario is that the company can't pay back the money that you've lent them. You lent them money to the bank and they can't pay it back, or whatever the corporate might be. Upon not being able to do that, and we execute our rights as a bond owner, as a lender to the organisation, we rank somewhere and that company will be wound up. So then you'll get a cents in the dollar response. It depends how high you rank and how much the assets are. So the worst case scenario is they don't pay their money back and there are no assets and you do not get paid back at all. The likelihood of that is not that likely, because you should be looking at something that's pretty good investment grade. That's what you'd be thinking about. The other part that Richard's now talking about is he's saying, what happens if a fund manager, it triggers an action on the fund manager? So in other words, the fund manager himself or herself struggles, and then they have a liquidity, they have to gate it, then it becomes a reconciliation around what assets they own. That becomes much more problematic. So you need to find good fund managers or good borrowers. That's the way to think about it. Dan's talking about the fact that rates go higher. That was triggering it, and if that happens, you might actually make more money, because think of a hybrid going higher, think of a floating rate going higher, your cash coming into you is much better. So rates go higher because economies are going well. So you'll actually do pretty well. So the worst case scenario in a bond investor is binary. You don't get your money back, and then when they wind it up, you don't get any money back again. That's the worst case scenario. So it's just a question of what are the covenants, what are the protections.
It actually kind of shows the beauty of what you can do with bonds. There's so many different components to it, in the capital structure, floating rate versus fixed rate, so it's completely dependent on what you're trying to achieve, because you get completely different outcomes.
Clive, there's not just one bond market. There's a varied bond market, just like there's a varied Blues rugby league team. Well, look, we'll have a quick break. We'll have our final segment after a word from our sponsors. We'll talk to you soon.
If you're planning on selling your home, what's the best way to get the best price for it? You could add a games room. Do some landscaping. You could put in a home theatre. Add an extra bedroom with ensuite. But the best way to get more for your home is to find a great real estate agent. Local Agent Finder compares from thousands of agents, including their fees, in minutes. Ballroom.
There's tough. And then there's a new breed of tough. The new Amarok, now standard with App Connect and rear view camera. From only $42,990 drive away, now with free 8-speed auto.
Power to the people, with a lot more to play with every month. Want to double your data? Switch to Vodafone, and for a limited time, get 18 gig for just $45. Switch today and keep your number. Vodafone. Power to you.
Get that tax-deductible feeling right now at Officeworks, where everything could be tax-deductible. Like this versatile Lenovo IdeaPad laptop, just $329. Or this Samsung Galaxy S8 with stunning infinity display, only $1,197. And back up with this 1TB WD Elements USB 3 portable hard drive, just $68. With thousands of potential deductions in-store and online, Officeworks is your happy tax place. If you've got the big ideas, Officeworks has the lowest prices.
How hard is it to find a home loan online? Sifting through so many different rates, what loans do you even qualify for? It seems impossible until now. Lendy does the hard work for you, instantly comparing thousands of home loan products from over 30 Australian banks and lenders to find the right home loan for you. No lining up at the bank or applying for the wrong loan. Now you can complete your home loan online. Just visit lendy.com.au. Whether you're buying your first home, refinancing for a great rate, or investing in property, Lendy allows you to compare all types of home loans from a huge panel of major lenders to choose the one that's most suitable for you. Next, apply for your loan online at Lendy. And if you need help, chat to a Lendy concierge who'll make your home loan settlement easy. Don't waste time doing it the old way. Compare, choose and complete online the easy way with lendy.com.au. Lendy, your home for home loans.
Fame's fickle. While some are celebrated, others go unrecognised. Take the traffic light, saved so many lives. But whose brainchild was it? Yeah, whoever thought of roasting coffee beans? The mobile phone, who was the inventor? What about Wi-Fi? Any ideas?
You don't have to be famous to be brilliant. Skoda. Simply clever.
Welcome back to Your Money, Your Call. I'm Mark Todd from the NAB. I am joined by Dan Miles from Innova Asset Management, and I've also got Richard Murphy from XTB. We're in our final segment, so if you'd like to talk to us, and it's been a great show so far from all the emails and calls, have another crack. 1300 30 34 35. The email yourmoney@skynews.com.au. For those who are late to join us, this will be the last show for 2 weeks. But in saying that, we've taped a whole bunch of shows, so you will have shows to watch. And it'll be a lot around the education front. We've had some cracking shows on Monday. I did 2 shows in a row. It was exhausting, but it was great. We had Dave DeGarris on, and he has got such great insight. Dave will talk to you all about property and about what he thinks happening in the property market and, in a broader sense, the economy at large. But what I want to talk to you guys in the final segment is about that active versus passive. I've been very keen to get people's sense of it. A lot of people are, I mean, all the people that come on the show will basically be saying, I want to be active, but passive are winning the day. They're winning the argument. So I don't have a view either way. Everyone's got their own horse. You know, they can climb on it and ride off into the sunset.
I use both. I utilise both.
Okay.
Where I think it makes sense to use passive, I use it. Where I use active, where things are inefficient. But I heard a great analogy once, because I've heard a lot of people saying a lot of negative things about passive, but I heard a fantastic analogy where passive funds, there's no consumer good you can find anywhere where the cheapest version of it is better than 70 to 80% of every other option available. And if you think of the cheapest car in the market, I don't know, something that costs you 15 grand, imagine if it was better than every Toyota and every Mazda and every Audi and half the BMWs and most Mercedes, and it only cost you 15 grand. You would be amazed. Like, that would be a fantastic buy. Or a blender or a coffee machine. Like, if you could get something that is the cheapest by far and better than most of the other things as a consumer good, you would think, wow, that is a fantastic deal. Sure. That's what a passive fund is. So they're not saying they're the best. They're saying they're pretty good and they're cheap. So if you look at it in that context, it's a pretty decent offer, and you won't find a consumer offering like that anywhere else in the world in any field. So we utilise them to get cheap market exposure to certain areas when we want it. But where markets are relatively inefficient and information flow is hard to get, we utilise active managers where we think they can add value.
I just want to Dan for one more question on that point. Is the trick to all of this, because everyone always gives me the number as if you're fully invested the whole time. If you bought that ETF or whatever through the life of the last 3 years, you would have made X%. People don't do that. That discounts the reality that people take the money out and do something else with it and put the money back in. Does passive become a function of, the old-fashioned stock picking? Like, I want to be in the bond index, I want to be in the emerging markets index, I want to be in, there's so many passive options around. Is it beholden on you to get it right in terms of how you allocate to it?
On me or on the individual who's watching the show?
The individual who's using it. The people who are watching this show saying, I'm passive, I'm going to buy a passive fund.
Yeah, well, I guess it is in a sense because they need to... You've brought this point up a couple of times and you're 100% right. People need to be prepared to stomach the volatility because there will be no active management of somebody to manage the risk that's inherent in that portfolio. The onus is on you to make sure that you can stomach that volatility and that it's an appropriate part of your portfolio, because you're going to cop the entire lot, and you do need to stay invested. So, I would argue that buy and hold and just leaving in, static asset allocation is not the optimal way to run a portfolio throughout time.
So, XTB is a single stock ETF.
Yep.
What's your thoughts?
We kind of sit in the middle. I've got a general observation. My general observation: active versus passive. The debate rages every few years. It gets crazy, and at the moment it's going crazy with the active guys accusing the passive guys, and vice versa. And I've always been of the view that look, there's a very broad spectrum from purely passive through to purely active, and there's everything in between because purely passive is morphed into smart beta, etc., and it just kind of merges. That's my general comment. My bond-specific one is an observation I've only realised. I was heavily involved in getting bond ETFs up through ASIC when I worked at ASX. And I just thought of them blindly as they're the same as equity ETFs are tracking a good index. Whereas I think you mentioned the index, the Oz bond index. It's a bunch of government bonds, a bunch of corporate bonds, and there's no real sense to it. It's just whoever has bonds on issue. So why would you want to track that index in the first place? I know why you want to track the ASX 200 equities. Biggest equities, the most liquid, makes sense. They're kind of the best. That's a measure of the kind of the best. Whereas tracking an index that just has whatever the government might issue from time to time to whatever corporates might issue. They're not even the best corporates. It's just who issues debt and who's got the most debt. Might be the worst companies that got more debt than ones that don't have debt. So what is the point of that index? Therefore, what's the point in tracking it? It doesn't make any sense to me. So my view on fixed income ETFs is very different to my general view. I think ETFs are a wonderful, wonderful invention. And so it's not all about active. There's passive as well. And so I like both. But in fixed income world, unless the index makes sense to me, and the corporate index, tracking that makes more sense to me than just a mishmash index of whatever investment-grade bonds are out there.
Would you describe the Aussie Corporate Bond Index a mismatch index? Like, are you on the same camp?
Oh, the Ausbond Composite Index, I do. I don't think it's an appropriate index for any retail investor. Because I don't think any retail investor would know what's in it. I think most retail investors compare their fixed income assets to cash, and so they want to look at things that are relatively floating rate and receive some kind of credit premium for it. And I think they're better off coming to talking to yourself or talking to Richard as opposed to buying the Ausbond Composite. The other thing about the Ausbond Composite is, as Richard has alluded to, it's whatever is on issue. The interest rate sensitivity of that index since 2009-2017 has gone from 3 years to just over 5 years. Most people wouldn't even know that because they don't track it.
So what he's saying here is that you've lent somebody 3 years. I lent Richard $1 for 3 years, and while I was not looking, it extended to 5 years, and I didn't get the extra premium. I didn't get the benefit of lending longer. I should have got a higher rate, and that's because all rates everywhere's rallied, and so you're staying with it. You're actually making money, but you've actually extended the curve. So when rates go up, if rates go up soon, which they won't, but if they did, you'd lose money. What are you worried about? We've got about 2 minutes to go. What worries you? You might say I sound like a broken record on things like hybrids. I worry about individual investors. This is a broken record.
Individual investors who don't understand it. You understand it. You understand it. Chris Joy understands it. I'm just worried about the people out there who don't understand it. And when bank equities were falling recently and bank hybrids were going up, that didn't make an awful lot of sense really at all. And that was just shortage value. And it took the banks collapsing in Spain before it fell over.
There's going to be something like, I don't know how many millions in the next couple of weeks.
Billions maturing.
It will not be rolled. So in other words, what happens is there's a whole bunch of listed securities, and when they are called, in other words, when they're redeemed, you hope that the borrower, CBA, ANZ, Westpac, would go out and borrow again. They're not. And so what that's doing, what it's saying...
Fascinating, actually.
...is that it's very expensive, so that's why they're rallying. In other words, if it's very expensive for me to borrow, for you to lend, you want to do that. I'm saying, well, I don't want to do this. It's very expensive. And so that's what we're seeing, that rally in those sorts of credits, because they're thinking that banks are becoming quite stable. That's what they're saying. Right, 30 seconds. What worries you?
What worries me is prices in US equity markets and the concentration in, Facebook, Apple, Amazon, Netflix and Google or Alphabet. It's become very concentrated and extremely expensive on just about every metric. And the problem is the rest of the world could suffer a contagion effect if we see a sell-off in that US market. And we don't really know, what the spillover effect could be. That's what keeps me up at night.
Impact the Fed and what they do with their cash rates. Look, that's all we have time for this evening. That's Your Money, Your Call. If you have missed the show and care to listen to it again, catch up on the program on your favourite podcast platform. Search for Sky News, Your Money, Your Call. Thanks very much to my guest, Dan Miles from Innova Asset Management, Richard Murphy from XTB, and for you, the viewers who've called and emailed. I'm Mark Todd from the NAB. Have a great weekend. I will talk to you live in a couple of weeks, but we do have more shows, so I hope you enjoy them. Email me if you care to give me your thoughts. Take care.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.